Hello and welcome to this session. This is Professor Farhat. In this session, we will work an example that deals with the auditing of cash and financial instrument. We worked a short example earlier about check kiting. Now we're going to work a more comprehensive example. So we're going to be working at this example to illustrate some concept we have learned in this cycle as well, maybe as in other cycles as well. So we are giving 7 scenarios, possible misstatements due to errors and fraud, and we are giving list of auditing procedures. So basically we need to take a look at what happened and what procedures we can employ to mitigate that situation. So let's go ahead and start. The auditors suspect that a lapping scheme exists because an accounting department employee has access to the cash receipts, also maintain the account receivable ledger, and refuse to take any vacation or sick days. Yes, this is a classic lapping scheme. Now, what is a lapping scheme? Well, we covered lapping scheme in our auditing cash collection cycle. So basically, it was not with the cash and financial instrument, was the cash collection cycle. So you could go back and view this. But simply put, I'm just going to explain it real quick. Lapping is when that individual, that suspect, steals from one account and cover it with another. So what happened is this. In a typical day, the company might receive $10,000 from account receivable collection. So we have 4 different accounts. Account 1, let's see, this is account 1, account 2, account 3, and account 4. And those $10,000 are for account 1, $3,000 for account 1, and $7,000 for account 2. So $3,000 supposed to go to account 1, $7,000 supposed to account 2. So what happened, the person that's committing this fraud, they will post the $7,000 to account 2. So account 2 is fairly posted, if it's properly posted, and they will take this $3,000 for themselves. So they will take this $3,000 and they will spend it themselves. Hold on a second. Now, account 1 is short. Account 1 is short $3,000. Not a problem. Tomorrow, the company would receive an additional $10,000 in payment, or the person would know how much they receive on average. Now notice, that's why this individual is not taking vacation or sick days, because they have to be there the second day. The second day they receive $10,000. Now of that $10,000, they will cover the shortage. Now customer 1 is happy, customer 2 is happy, then they will pocket the rest, which is either for customer 3 or customer 4. Then the following day they would receive money, they will cover the shortage for either 3 and 4, and they will keep that money. And that's why a person that's committing the slapping scheme, they cannot take a vacation or sick days, because once they do, they will be immediately uncovered. So what do you have to do as an auditor to check this if you're suspecting this? Simply put, what you have to do is this. Compare the detail of cash receipt journal entries with the detail of the corresponding daily deposit slips. So basically say, okay, select a day and tell me how much did we receive. Show me the customers that we received. We received for customer 1, we received money from customer 2, customer 3. So those are the 3 customers that paid us. Go back to their individual account and make sure their accounts are posted appropriately. And this is how you will uncover them, because that individual can no longer, then they'll have short somewhere that they can no longer cover. So this is how you will check for lapping. 2, the auditors suspect that the entity is inappropriately increasing cash reported in the balance sheet by drawing check on one account and not recording it as an outstanding check on that account, and simultaneously recording a deposit in the second account. This is basically check kiting we talked about in the session, and we looked at an example. So if you don't know what check kiting is, I did work a quick example, and I did cover check kiting when I did the auditing cash fraud. Okay, this is what we're explaining here. So how do you uncover check kiting? Well, we already talked about this. You prepare a bank transfer schedule. A bank transfer schedule that looks like, let me see if I have it here, that looks like this. And if you remember when we worked this example, we were able to find out that check kiting is going on. So what is check kiting? Is trying to make the money appear in 2 different bank accounts. Basically, we have 2 different bank accounts, account A and account B. So you make the deposit in account B, you make a deposit of $50,000, but you don't deduct it from bank A. You don't show it went out of bank A. You don't show the negative, you only show the positive before year end. So it shows as we have more cash than we should. This is also done when someone is stealing money. They want to cover their theft, so they will commit this kiting, or if the company wants to overstate their cash. So prepare a bank transfer schedule will help you discovered that check kiting scheme. Number 3, the entity cash receipts for the first few days of the subsequent year were properly deposited in its general ledger account after year end. However, the auditors suspect that the entity recorded the cash receipts in its books during the last week of the year under audit. Here what we have is cutoff. So this is year 1, this is year 2. So the company received the cash here, but they went back and they posted the cash in year 1. Okay, what do we have to do under those circumstances? Simply put, well, we're looking at cash receipts. Compare the detail of cash receipt journal entries with the detail of the corresponding daily deposit. Well, year 2, we should have a corresponding daily deposit with dates on them that says year 2, and they're supposed to be in year 2, not in year 1. So it's easy to uncover this, just like you would uncover lapping scheme. Okay. Number 4, the auditor noticed a significant increase in the number of times that petty cash was reimbursed during the year and suspect that the custodian is stealing from the petty cash fund. So the auditor is saying we are reimbursing the petty cash very often. That's not good. Well, let's see B. Does B solve the problem? Count the balance in the petty cash at year end? No, it's going to be correct. What we need to do, we need to examine invoices, receipts, and other documentations supporting reimbursement. If we're suspecting someone is stealing money, then guess what? From the petty cash, just review the petty cash. For every disbursement, you should have a receipt. Look at the receipts, look at the invoices, examine their authenticity. Are they legitimate disbursement? This is what you have to do. Number 5, the auditors suspect that kiting scheme exists because an accounting department employee who can issue and record checks seems to be leading an unusually luxurious lifestyle. So here what's happening, we suspect that someone is stealing money from the company. And how are they hiding their theft from the bank reconciliation? Every time at the end of the period, they will transfer money from one bank account to another, recording the deposit in one bank and not the disbursement in the... So again, A and B, bank A and bank B, they will add the money to bank B at the end of the period without subtracting it from bank A. Now, again, what's going to happen is the following month, I'll have to do the same thing again to make it appear as we have money when we don't. Okay? So this is, what do we do? Again, and those circumstances, yes, a bank can prepare an interbank transfer would help, but also what you have to do here to stop this, you have to ask for a bank cutoff statement and compare the clear check to the year-end reconciliation. Here, the bank cutoff statement would also uncover this scheme, okay? So a bank transfer will show you that there's something going on, but the bank cutoff statement will basically show you after year end which checks are covered. So you will know for sure what is happening. Number 6, during the test of the hopefully we all know what a bank cutoff statement. Bank cutoff statement is at the end of the year, you would just look for, if this is December 31st, if our year is December 31st, what you do is you'll ask for the first 2 weeks in January to see what checks were cleared. Okay? And to who? During the test of the reconciliation of the payroll account, the auditor notices that a check to an employee is significantly larger than other payroll checks. So this is basically analytical procedure, and you notice one check is a little bit bigger than the other. It's a little bit unusual. So what do? Pull the check, show me the supporting document. Show me the supporting document. So examine payroll checks cleared after a year. No, not this one. It should be, let's see. You should be looking at the hours. Agree gross amount on payroll to approved hours and pay rates. So basically, your check is $5,000. Well, okay, if I believe this is overstated, show me the hours. Show me how many hours you work and your pay rate. So it's easy to check this. Okay. And 7, the auditors suspect that the controller wrote several checks and recorded the cash disbursement. Just before year end, but did not mail the checks until after the first week of the subsequent year. So basically, here's what happened. They wrote the checks. This is year 1. This is year 2. They wrote the checks in year 1, but they did not mail them, but they deducted them from the books. So they deducted the recorded the cash disbursement. They deducted the money from the books, but they did not mail the checks until year 2. So in year 2, they mailed the checks. So they recorded the entries in one period and they mailed the check in the other period. Now, how do we know this happened? If we suspect this, bank cutoff statement. What would the bank cutoff statement show? The bank cutoff statement shows when the check were cleared. So basically, you would look at the bank cutoff statement, compare the clear checks. So if, let's assume, just going to give you an example, let's assume there was supplies expense. So we debited supplies expense on the books, $500, just to illustrate the point, and we credited cash, $500. Now, obviously, when we send this check, this was check number 100. So the check is number 100. Okay. Now we go to the bank cutoff statement, and we notice that check number 100 did not clear until January 15th. Okay. Now, it did not clear until January 15th. But the related expense was recorded in the prior year. So we suspect, what are we suspecting? We're suspecting that the check was not mailed because it should have been cleared much earlier. So what happened? We need to go back and put that check on the bank reconciliation. So a cutoff statement will show you what checks were cleared, and let's see if they were on the bank reconciliation. Because if what happened is they did not mail the check, okay? They did not mail the check until the following year, okay? So it's not on the bank reconciliation. It should be on the bank reconciliation, because if you recorded the entry, let's assume this entry was 12/28, December 28, you recorded this, therefore the check should be outstanding as of 12/31. It's not there. Okay, why? Because you did not mail it until the following year. So this is how the bank cutoff statement will show you what happened. If you have any questions, any comments, by all means, email me or see me in class. And if you're studying for your CPA exam, always, always, always study hard. It's worth it.